David Burrows of Barometer was on the program on the 12th of June of last year. At the time, he brought with him three top picks. You're up a combined 25.8%. Of course, we started the program by talking about how much you dislike energy.
Yes.
Top pick number one from this time last year, Diamondback Energy. That one's down 9%.
Yeah, so heading into last summer, we had roughly 40% of our portfolio split between energy producers and service companies and infrastructure. And from time to time, you get watershed shifts in the market. We use a breadth model that tracks the percentage of stocks within specific universes that are performing well. And when breadth starts to deteriorate, that tells us that the tide is starting to go out. So in June of last year, there were 66% of U.S. oil stocks were performing well. That percentage started to fall. To us, that means raise a bit of cash, tighten up your stop losses, which we use on all of our positions. And if you get stopped out, don't go back until breadth starts to improve. And realistically, breadth deteriorated from June of last year through year end and into about February of this year. So really by September of last year, we had virtually a zero weight in energy producers. And we continue to avoid the group. We think that there are better sectors to be focused in.
Top pick number two from this time last year is NXP Semiconductor. This one's up about 73%. Have you taken any off the table after a rally like that?
I would buy this stock today. I think that this is a natural winner in the world of the Internet of Things. NXP really dominates near-field communications, the chips that go on your credit card, that are in your iPhone for Apple Pay, and now chips that go into cars with their recent acquisition in that area. So this is a company that will benefit as we have more and more connected devices, and they are the leader. So a semiconductor sector hit a new high this past week. There's lots of M&A taking place in the space, people paying premiums, as we've seen. So I think this is in the sweet spot. It's an economically sensitive group that benefits from a slowly improving economy, and they're in the sweet spot of semiconductors.
Looks like it's got some growth opportunities. I pulled up the PEG ratio. It's 0.85. Anything below 1 suggests there's some upside torque.
It's trading at 19 times next year's earnings. So, you know, the company's growing at sort of 18 to 20%. I think that you're going to continue to get multiple expansion and things that are attached to the Internet of Things. It's not terribly expensive. People talk about tech stocks being expensive. In 2000, the NASDAQ 100 traded at average 100 times earnings. The top 10 stocks in the NASDAQ 100 today trading at 16 times next year's earnings. We've only just recently made a new high. We believe we're in relatively early stages of a strong market for technology.
Top pick number three from this time last year, RPM International, which is now up by about 13.5% since you recommended it.
Yeah. So the chemical sector is a sector that benefits from very low cost natural gas in North America, big cost input. And so actually, interestingly, this is one of the industries that's growing in the U.S. There's new manufacturing capacity being built in chemicals because of those very low-cost inputs. RPM specifically is in the paint business, and home improvement has been a big theme for us. There was a lot of pent-up demand. It's one of the first places consumers are spending money as they're becoming a little bit more solid from a balance sheet perspective. Home Depot is another way to play this. Sherwin-Williams is another way to play this. I think that all of these companies look very attractive.
Are you playing it at all for the dividend yield? 2.1% doesn't seem like a lot to write home about.
Well, you know, certainly we're in a world right now where chasing the higher dividends with lower dividend growth is not the place you want to be. You want to be in things with lower dividend payouts, but that are growing more rapidly. So, for instance, we run an income portfolio, and that portfolio right now has a negative correlation to the bond market. In other words, it's an income portfolio, but as bond yields go up, bond prices come down, these securities benefit.
Right.
And that's largely because they are economically sensitive companies with rapid dividend growth that accelerates as the economy gets a little better.
It does seem to have a reputation for raising its payouts every 4 quarters.
Yeah, there's a bunch of companies. To go find double-digit dividend growth right now is a breeze in the S&P.
$53 is where the street says it'll be a year from now. What do you think of that?
I think that this group looks attractive. I think that the stock company's well managed. I see no reason why it can't continue to rally.
David Burrows is our guest, President and Chief Investment Strategist at Barometer Capital Management. We're taking your questions on North American large caps. We've still got a line open if you'd like to join us, 1-855-326-6266. Works right across the country. And when we come back after the break, we'll talk about the world's biggest chip maker. We're back in a flash.